Anything can be deductible. It's not the thing that makes it deductible. It's how that thing is used. First of all, there has to be a business purpose to it. Okay. Second of all, it has to be a typical expense for your business. We call that ordinary. Third, it has to be necessary, meaning that it's in the intention of spending the money is to make a profit from spending that money. And the fourth is it has to be documented the way the IRS wants it documented. There are very few things that aren't deductible if you meet those four tests.
Albert Einstein said the hardest thing in the world to understand is the income tax. And another brilliant mind, Snoopy, once wrote, "Dear IRS, I am writing to you to cancel my subscription. Please remove my name from your mailing list." I think that in both of those quotes, we can find ourselves each and every April. And to help us with that, we've brought on the absolute master when it comes to understanding taxes. Understanding taxes, especially from a real estate perspective, it's an honor to have him on the podcast. It's Rich Dad's own CPA, Tom Wheelwright. Tom, welcome to the podcast.
Thanks, Brent. It is just absolutely my pleasure to be here with you. Thank you.
This is incredible. So let's start with the hard-hitting questions, okay, Tom? What are taxes? Why do we pay income taxes?
Because there is an amendment to the Constitution, 16th Amendment, that forces us to pay income taxes. And the federal government decided that it would use those income taxes first to fight a couple of wars. And then they decided, well, we'll just use it now for social programs and besides the defense of the country. So it is a way to raise revenue. What it's become over the last 60 years is a way for the government to encourage certain behaviors. To say it the nice way, if you don't want to say it the nice way, to manipulate the economy.
Sure.
But it really is a way for the government to encourage people to do certain things.
So I hear the term tax basis, and I'm confused. What does tax basis mean for us, for the listeners, for the audience? What is a tax basis, and why does it matter?
So I've got to tell you, I love you asked me that question. I never get that question. And it is, for real estate especially, it's one of the most important questions because tax basis is what you base all of your deductions off of your tax basis. So if you have, if you own rental real estate, for example, your tax basis is essentially the purchase price of that real estate. It's not the money you put in. It's the money you put in plus the money the bank put in. That's the tax basis. And you get to depreciate the tax basis. You don't get to depreciate more than the tax basis, but that's what you get to depreciate. On top of that, you know, people ask me things like, well, what if I donate my time to charity? Well, you have no tax basis in your time.
Right.
So you don't get a deduction. You get a deduction for the things you have a basis in. So it's really your actual financial cost of acquiring something minus any deductions you've taken with related to that cost. So if you deducted it, you have no basis in it. If you deducted a portion of it, you have less basis in it.
And you talk about deductions. Is there like just an easy list? Is there like, I don't know, 10 or 15 deductions that you know are pretty common that would help us to not pay as much in taxes? I mean, listen, we got to pay taxes, right? This is the rent that we pay to live in this country. It affords some incredible programs. I mean, we all understand that we're not going to know where every single cent of every dollar goes to, but I think most people understand that paying taxes is probably a smart idea to live in this society. But if we can pay less in it, that's pretty interesting too, as long as the government says, hey, if you spend money on certain things, these deductions, these things that'll deduct what your taxes are going to be based off of, that's good. Shouldn't that list of deductions be pretty commonplace for everybody in America?
Well, actually, you can go even a step further. Anything can be deductible.
Okay.
So it's really, it's not the thing that makes it deductible. It's how that thing is used that makes it deductible. Okay. So there's really only 4 tests for a deduction. First of all, there has to be a business purpose to it. So that implies that you have to be in business. So people that aren't in business don't get very many deductions. Okay. Second of all, it has to be a typical expense for your business. We call that ordinary. Third, it has to be necessary, meaning that it's in the intention of spending the money is to make a profit from spending that money. And the fourth is it has to be documented the way the IRS wants it documented. So if you meet those 4 tests, there are very few things that aren't deductible if you meet those 4 tests. And there's very few things that are deductible if you don't meet those 4 tests.
And is that deductible for everybody, or is that only if you own a business?
Well, again, first rule is business purpose. So if you don't own a business, you don't get the deduction.
So even if you're out there and you're an aspiring entrepreneur and you're buying properties, but you don't have a business set up, does it not count?
Well, if you're actually in the business of renting real estate, you are in business. Whether you have an entity or not is irrelevant. Okay, what matters is, are you in business?
Right.
So when you rent property out, you are in the business of renting property out. If you own a taco shop, you're in the business of selling tacos, but it's still a business. So the question simply, are you in business? And if you are, now you can take business expenses.
So why are we always taught set up your business before you start anything, because then you can have all these deductions? Is that just a myth?
That's a myth. That's absolutely a myth. It is wise to set up the property entities because you get better tax benefits when you do. You pay less tax if you set up those entities properly, but you don't gain deductions by setting up a certain way, and you don't lose deductions by setting up a certain way. You have deductions because you're in business.
Got it. And that leads us to the queen of deductions. The queen of deductions is, as you say in your book, document, right? Mm-hmm. And this was always something that was very concerning to me. As soon as I became a real estate agent in 2004, and I was told, well, you got to keep your receipts for all of your gas and your cell phone bill, and you got to do all these things. Do you still have to keep receipts? Can it just be that you have bank statements? I feel like every time you use a card, that is recorded. I mean, that should be documented.
That actually doesn't qualify as a receipt. So you literally do have to scan in your receipts. You need to scan. You need to scan those receipts. The IRS can ask for those, and if we like to say, if you pretend to document, you get a pretend deduction. So the IRS, the very first thing. Remember, the IRS. They're hiring all these new people, and these new people aren't going to be well trained. What are they going to do? Well, they're going to go in with this checklist, and I'll tell you what, the first 10 things on their checklist are going to be documentation. That's what they're going to go after. Because a lot of people don't document. We think our credit card statement is enough. No, it's not. We think our bank statement is not enough. No, it's not. You remember that the general rule is nothing's deductible. That's the general rule. And then, so that means that you have to prove that you meet an exception to the general rule. And that exception includes documentation. So
you said a minute ago, everything's deductible or anything's deductible, and then nothing's deductible. So
everything can be deductible.
Got it.
Given the right facts and circumstances. We like to say, if you want to change your tax, you have to change your facts. So simply it's not the item that is deductible. It's the use of the item that's deductible.
Business purpose, right?
Right.
It's an actual expense. What was that?
That's ordinary.
Ordinary.
It's a typical expense,
right?
So ordinary.
Necessary and documented.
Correct. That's it.
And when choosing, I like to focus on going after great deals, finding great opportunities, buying great properties, buying great assets, and having a CPA handle all this. Right? Is that dumb to do? Should I be more involved in this? I mean, they tell me they need certain things that I get them throughout the year, but is there a better way? Is there a better way to set this up so that, I'm not, because there's always this fear, right? There's always this fear that you're going to get audited, or you did something wrong, or you're going to owe more than you did. And now you've got penalties and all these other things. And so how do we do this right when we're focused on really, we're putting all of our efforts into building a business, a successful business, but then we also have to have all these responsibilities on this side? What's the best way to be able to handle that?
My favorite quote from Robert Kiyosaki is investing is a team sport. Mm-hmm. So we want to be involved with our team, not just hand something off to our team. We want to be involved with it. Remember, I can tell you how to make something deductible, but you're the one who has to actually do the work to make it deductible. I can just tell you what to do, but I can't make something deductible. So the idea that you can turn it over to your tax professional is a myth. You can't turn it over. If you do, you could, but you're going to pay maximum amounts of tax, and you're going to always wonder, am I going to get audited? Am I doing something right? If you have that regular relationship where you're communicating at least on a quarterly basis with your CPA, life gets a lot better, because you should always know where you are during the year, how much tax you owe for the year. So first quarter, how did I do this quarter? Okay, what am I expected to owe to pay that tax in the first quarter, second quarter, third quarter, fourth quarter? And then what happens is, come April 15th, you already know in December, you know exactly what your tax is going to be. So there are no surprises whatsoever. And on top of that, if you're doing this all throughout the year, then your CPA can be telling you, well, what about this? Have you thought about this? Well, what are you doing here? Are you doing this deal? Maybe you need to do a deal. Maybe there's a deal you hadn't thought of doing. You go, I wonder if I should do this deal. What are the tax consequences of doing this deal? Because the tax consequence may make the difference between being a not so good deal and being a great deal. So I think that, with our clients, we're constantly talking to our clients. Yeah. We insist on that relationship being a partnership, because it's very difficult for us to be successful if you're not involved in it.
That's Wealthability.
That's Wealthability. That's
Tom
our Wealthability
is the CEO
network.
of Wealthability, and absolutely incredible. And you actually train a lot of CPAs around the country as well.
Yeah, we have 65 CPA firms that we train every month.
Oh my gosh. So guys, if you're interested in that, definitely check. What's the best way to check that out, Tom?
Wealthability.com. Pretty simple.
Wealthability.com. Awesome. There's 5 buckets of income, right? And I've got earned, ordinary, investment, inheritance, and passive. Is that still the case?
Okay. I can go for that.
Okay. And
sure.
In those 5 buckets, the buckets that have the most leaks is earned income?
Well, earned income is the worst kind of income. It's the highest taxed income, because not only are you paying income tax, but you're also paying Social Security and Medicare tax. So it's absolutely the highest taxed income we have is earned income.
And what about inheritance?
So inheritance isn't. So here's the thing: if you receive a gift from somebody or you inherit from somebody, you don't pay any tax. It's the person making the transfer that pays the tax. So if I'm like, if I give my kids some money or some assets, I pay the tax on that. They don't. That's called a gift tax or an inheritance tax, an estate tax. If they inherit it from me, it's the estate that pays the tax, not the recipient. So that's actually a very different kind of tax, because it's not based on income. It's based on wealth.
Got it. And passive income?
Passive income's the best, because passive income you can literally eliminate. You can easily have zero taxable income when your income is passive.
And how does that happen?
So passive income is basically a business income that you don't actively participate in the business. So it's passive, right? Rental real estate, by definition, is passive. There's ways to make it non-passive, but by definition, it's passive. So, income from rental real estate, income from a business that you spend less than 500 hours a year, that's potentially passive income. And the great thing about passive income is it's really easy to create passive losses, and passive losses can only offset passive income. So like real estate, like I said, it's by definition passive. Really easy. Take somebody like me. I'm never going to be a professional real estate investor. I spend all my time in business. So I've got passive losses coming from my real estate because of the big depreciation that comes through. Okay, well, I can't offset those passive losses against my active income. So like I'm full-time at Wealthability. So my Wealthability income is active income. So I've got this mismatch. I've got ordinary income from Wealthability. It's not earned, but it's ordinary. And I've got passive loss from real estate. So what do? Well, I have other businesses that are passive. I have rental real estate that's passive. I have I have other business interests that are passive, and those produce income that can be offset by that real estate loss. So I think passive income is a little bit of magic because that's where you get to that tax-free wealth.
You mentioned something called active income. Also, is that also ordinary income? Is that
active income is really the opposite of passive. So it's either passive or active. So all income that's business income is either passive or active, but it has to start by being business income.
Meaning you're the owner.
Meaning you're an owner.
Got it.
Correct. So if it's wages, that's not active or passive. That's just earned. Okay. If it's interest and dividends, that's investment income. I'm sure you get to that one. That's investment income, but because it's not a business, it's not active or passive, right? It's something else. So active and passive are simply two sides of the same coin.
Okay. So you've got, if you own a business and you get like an owner draw, that is more the active and ordinary. That's not earned.
Yeah. So to be clear,
your
actual draw is not income.
Okay.
Okay. In a smaller business, typically you're in what's called a pass-through entity, like an S corporation or a partnership. And in a pass-through entity, the entity doesn't pay any tax. So there's no corporate tax on it. The owner pays the tax. Mm-hmm. Well, you're taxed whether you take the money out or not.
Yep.
So the actual distribution isn't what causes the tax. It's the earning of the income. So even if you leave it in the company, you're still taxed on it.
Right. And so how is earned income is if you pay yourself a salary, and the active and ordinary income is just the income that the business makes?
Well, unfortunately, if you don't set your business up right, all of your income could be earned income. So that's where that initial discussion, Brent, about what entity to use makes a big difference. Because if I set myself up, for example, as a sole proprietor, 100% of my business income is going to be earned. Not real estate rental, that's different, but 100% of my active business income is going to be earned income. Whereas if I set myself up as, for example, I'm a limited partner or I'm an S corporation, then it may not be earned, it may just be ordinary, and I don't have to pay those extra employment taxes.
Right. So again, guys, just for everybody listening, if we're just talking all over the place, earned income, active income, investment income. Investment income is more like what you would earn from
dividends, capital gains.
Okay. Inheritance income is a whole kind of different animal. And then passive income is coming from, is it mostly rental properties, passive income?
No, passive income can come from rental properties, but it also can come from any business. You're an owner in the business, but you're a passive investor.
So did you say less than 500 hours of work a year? That's
the general rule. Now, you can still be considered active under 500 hours, but the general rule is 500 hours.
I love it. Why can we depreciate property? Why does the government allow us this beautiful thing called this depreciation? Why do they allow it? Why doesn't the government be like, no? If you want to own real estate, that's great. We know it appreciates over time. This is a nice asset for you. We're not gonna play this game where you depreciate. Why are they encouraging us to own property?
That's a really interesting question because, in most countries, you don't get to depreciate used property, only new property that you build. So basically, if you think about it, should you really be able to depreciate property over and over and over again? And the answer is no. It makes no sense, right?
Right.
You should be able to depreciate it once because, it does wear down, right? But why can you depreciate it, sell it, depreciate it again? The buyers, you can keep doing this. It's simply because it's an incentive to invest in real estate. So take where we were in 2017, right? We had this new tax law that gave us these huge bonus depreciation. Well, why? Well, we had a huge shortage of housing in the U.S. And so the government says, look, we're going to incentivize you to put money into housing. And if you do that, we're going to give you a big deduction. And so I don't know about you, but I know a lot of people that the reason that they got interested in real estate was because of the tax savings. That's what they got interested. Now, you always want to make money at your real estate. Don't get me wrong. Tax shouldn't be the primary motivation. But I think that it's the tax benefits that gets people interested in a lot of cases. And so people wouldn't do it without the tax benefits. And so in order to incentivize this behavior, this is, like I said, the way the government encourages certain activity. In order to incentivize it, they gave us big tax deductions. And the real estate incentives started with Ronald Reagan in 1981. That's when we first had big real estate tax incentives. We had our first big energy tax incentives were in 1986, also under Ronald Reagan. But now fast forward to 2022 is we now have big alternative energy tax benefits under Joe Biden because that's what he wants to emphasize. That's where he's encouraging people to put their money. So it's just an encouragement, just an incentive.
And that was because of a lack of housing?
That's pretty much what it was. Is we had such a deficit in housing that the government was incentivizing it. They say, look, we'll let you take bonus depreciation even on used property. I've never seen it before. I've never seen it in any other country. This was a once in a lifetime, I think. I don't think it's coming back. But if you look at it, this year we're supposed to catch up in housing. This is the first year we're supposed to have surplus in housing. All right. Well, I think it would be a mistake to think that was an accident, that we happen to have bonus depreciation for 5 years and all of a sudden we're caught up in housing. I think there's a correlation between the two.
Can you touch just real briefly on what does bonus depreciation mean?
Bonus is it's like super magic. So I call depreciation the magic of depreciation, right? Mm-hmm. In my book, Tax Free Wealth. Bonus depreciation is like scary magic. So basically, normally, under normal circumstances, you don't get a deduction for land because it doesn't wear out. You get a very small deduction for building because it wears out, but over somewhere between 25 and 40 years, right? You get a little bit bigger deduction for land improvements because that does wear out closer to 15 years. And then you get an even bigger deduction for the contents of the building because that tends to wear out in 5 to 7 years. So historically, those have been the rates. 5 to 7 years for the contents, 15 years for the land improvements, 27 to 40 years for the building, depending on residential versus commercial, and nothing for the land. Well, what Congress did in 2017 is they said, look, for the contents, the portion allocated to the contents and the land improvements, we're going to give you 100%. So we're going to let you deduct it all in 1 year. Instead of 15 years, 1 year. Instead of 7 years, 1 year. And so that means that anywhere from 20 to 30% of your purchase price, even if at the bank put in all the money, 30% of your purchase price was deductible the first year. Well, that could be easily a bigger deduction than the money you put down.
Sure.
So really the government literally was paying you to invest in real estate.
So just as an example, if you bought a building for $1 million,
right?
And now are they allowing any bonus depreciation still, or is that over?
Yeah, it's down. Well, it drops down 20% a year for the next 5 years. So it's 80% this year, 60% year after, then 40, then 20, then 0. Okay. So it keeps dropping 20% a year. So it's still 80% this year.
80% of
The contents and the land improvements.
Okay. And what about the building?
Building has always been, for residential, it's 27 and a half years. For commercial, it's 39.
And so if I bought $1 million building this year, and I made $1 million this year, what does that do to how much they're going to look at my income to be taxed?
Well, so if you put down 200,000 of your $1 million that you made, you're going to get a tax deduction probably of more than 200,000.
Okay.
So the 200,000. So think of it this way: the 200,000 that you put into the property, you don't get taxed on.
Got it. And there's this really strong, like it's like clickbait, Tom, right? Where it's like, if you buy a certain amount of real estate, you'll never pay taxes again, right? Can you talk to this clickbaity type of myth that's out there that all of a sudden?
Well, you can get to zero. Absolutely. If all your income is business income, you got to start with that.
Okay.
All your income, you don't have wage income.
Okay.
Right?
Yep.
You don't have interest dividends. You just have business income. You can literally offset 100% of your business income with real estate losses. The question is, do you want to? And I know that's a weird question, but the reality is that where you get the big bang for your buck is in that 30 to 40% range of tax rate, right? When you get below 20%, it's not a lot of bang for your buck. So when we work with a client, for example, our first target is 20. If we can get to 20%, that's the first big win. If they want to go beyond that, that's fine. But our first initial goal is let's get to 20%, because nobody's really gets upset about a 20% tax rate, but they get really upset about a 40% tax rate. So remember that every dollar of deduction comes off your highest level of income.
Right.
So that means you get your highest rates off first. And you can get down to that 20% actually pretty easily.
Yeah, I was told if I made $100,000, I would have to buy 8 times the amount in real estate to not pay any taxes.
That's not true.
Okay.
That's not true. First of all, if you make $100,000, you pay very little tax. Okay. People who make $100,000 don't pay much tax in this country. Because to begin with, you've got a $12,000 standard deduction. Okay. And then you've got tax rates that start at 10%, then they go to 12%, then you got 20% in the 20% range. So you actually have to have well over 100,000 before you get to the 30% range.
What about $1 million?
$1 million, now you're up in that 40% range.
Right.
So now you're talking real big bucks. So once you get over, as a single individual, about $450,000, you start paying that really high rate.
Yep.
But up until then, you're paying lower rates than 40%.
But is it 1 to 8? That's the thing that I'm like.
No. So here's what would happen is, it's actually, it depends on your debt equity ratio. Okay.
Yep.
So, if you're, let's say you're putting 80% down.
Okay.
So you can think if you're putting 20 to 25% down, you're probably going to get a deduction equal to the amount of your down payment. So if you literally took that $1 million and you say, look, I want to invest $600,000, you would get $600,000 of deductions pretty easily.
Got it.
If you leverage it, if you use Spanx money.
Got it. Amazing. That's perfect. I love it. Yeah, I'm just trying.
Simple.
I'm just, there's just that's the big, like you said, like being able to pay less in taxes is kind of a gateway into getting into real estate investing, especially people that want
a gateway drug, actually, if you think about it.
It is. Yeah, but I look at it and it's like, okay, I get it, but it doesn't look too good on your balance sheet if you're getting an extreme amount of debt to be able to do it, which is what a lot of people are doing, Tom. A lot of people are going out and either taking over loans or they're getting into some of these, syndicated type of situations, or they're doing creative finance and getting a lot of property, but they owe a lot of money on these deals.
Yeah, but can I share something on that?
I love it.
So just if you kind of look at financial statements, we have income, expense, assets, and liabilities, right? So the purpose of income is to create cash, right? It's to generate cash. That's the purpose of income. The purpose of an expense is to generate income. That's the purpose. That's why you spend the money, is to generate more income. The purpose of an asset is either to generate income or reduce expenses.
Yep.
That's the purpose of an asset. The purpose of a liability is to buy an asset. So here's my thought for you, Brent. If you're afraid of the debts because you don't trust the asset.
Yeah.
It's that simple. If you are confident the asset is going to produce income, which produces cash flow, why wouldn't you put as much debt as possible on there? Debt's cheap. I mean, even at 5-6%, that's cheap compared to equity. Equity is way more expensive than debt. I mean, the average equity investor is expecting, in real estate, is expecting 20 to 30% return on their investment. So that's a way higher cost to the developer than debt. Debt's really cheap, 5-6%, cheapest money you can get. But you don't, you're on the hook for the debt, right? You're not to the investors. Yeah, you're on the hook to the investors, but the reality is if you lose money, you lose money, and the investors know that. The bank, they're not so happy with that.
Right.
So, but the problem is that why would you invest in something with your own money that you would invest the bank's money in?
Right.
I've never understood. So to me, it's a matter of how well do I understand my business, which in this case is real estate. And if I really understand it and I have confidence in the business, why wouldn't I borrow?
So buy great deals.
That's it.
Just buy great deals. Buy great assets.
Buy great deals.
And that's the best strategy, right?
Yeah. Now there are times I would not use debt because I don't trust the asset. For example, let's say I'm buying to flip a property, right? Or I'm buying to wholesale a property. That's a little more akin to gambling, right? Because I'm not going to get cash flow. I'm getting, I'm actually having to sell the asset.
Yeah.
And so if I can't sell the asset, I'm in trouble.
Yep.
That's where people get in trouble with debt, is because they don't use it for the right things. Long-term debt should be used for long-term assets. Right?
Yep.
And a long-term asset means you've got rental real estate, either commercial or residential. It's not a fix and flip.
Love it. Tom, incredible. We went through a lot. I really appreciate your patience with it, because it is. I mean, I feel like, not to say that I'm anything like Einstein, but I understand the sentiment behind, it being the most confusing thing. And you've really opened my eyes to a lot, and the eyes of the audience for sure. So, guys, Tom has an incredible new book out, Win-Win Wealth Strategy. Definitely check that out. You can get that on Amazon. And check out, if you need a CPA, Wealthability. Wealthability.com. Make sure that you go check that out and get involved. He obviously knows what he's doing, and he's trusted by Robert Kiyosaki, who wrote Rich Dad, Poor Dad, and has been a Rich Dad advisor forever, right? I mean, you guys have been involved for a very long time. And
20 plus years.
How many?
Over 20 years.
20 years. Absolutely incredible. Anything else, Tom? Anything that I didn't mention? Any other way for people to connect?
Just thank you. Thank you for doing this, and thank you for getting out the financial education, because they're really the fastest way and the easiest way to put cash into your pocket is to reduce your taxes. It's your single biggest expense. Fastest way to put money in your pocket is to reduce your taxes. And it's a little of education. So I appreciate you doing this to get some of that education out to the investors and the business owners.
Awesome. Thanks, Tom. And for everybody out there listening, Listen to what Tom's saying. All right. Go out and get somebody that you are going to talk to every 90 days. These are on your personal board of directors. These are people that are going to protect you and educate you and really help you. And they're really masters in this part of the business so that we can focus on what we do best to go out and get deals. And that's it. On behalf of the whole Rhino tribe, I sign off by encouraging everybody to go out there and talk to people. Till next time, guys. Love you. See you.